for the 199A qualified business income deduction. This is a brand new deduction beginning in 2018. And I think it's going to have some impact on the type of entity that people choose and also the way they structure their business. And I'm already talking to clients about how to maximize the advantages of this particular deduction. So what I'm going to do is to give you a slightly accelerated presentation of this particular program. It's something that I do for Commerce Clearinghouse, which is one of the big publishing houses. And you'll get a slightly accelerated version just because you're not going to be actually using this with clients. I just want you to get an idea as to how a change in the tax law can actually affect how people structure their business. So what we're going to talk about are, let me just get my cursor here, eligible taxpayers. That is, who's eligible for this 20% deduction, general rules as to how the deduction works. There's a distinction between non-service businesses and service businesses, taxable income limitation that applies on your ability to claim the deduction, and then the definitions that they use and some of the other rules and some of the interplay that this particular deduction has with some of the other rules within the Internal Revenue Code. So the basic structure of this deduction is we have a 20% deduction for something called qualified business income. And so basically what that means is that you're going to determine your business income the same way that you've done in the past, and you don't really get an exclusion for it. And the reason is there's certain limitations that have to be applied first. But you'll be able to deduct 20% of your income. Now, the maximum tax rate for individuals now is 37%. So if we can knock off 20% of that business income, we save 7.4%. And that means that the maximum tax rate is 29.6% for anything that falls into this qualified business income structure. It's limited to 20% of your taxable income determined without regard to net capital gain income. And the reason is net capital gains are tax favored. The tax law has a preferential rate that applies to that. So essentially, they're not going to let you double dip. They're not going to let you get a favorable tax rate and also get this 20% deduction. And so the key thing is that this is available to anybody other than a C corporation. So a C corporation is a regular corporation. And I also provided you with a PowerPoint deck on the Section 1202 exclusion, and that allows you to sell stock of a C corporation and not pay any tax if it meets the requirements. And so this is a benefit that's available to other types of businesses. And the reason they came up with this is in 2017, they lowered the top tax rate for regular corporations from a maximum of 35% all the way down to 21%. That's a 14% reduction. So on a 35% base, that's a 40% reduction in the tax rate that applies to regular corporations. So the sense was that we're providing this incredible benefit for regular corporations. Most businesses are actually run in flow-through entities, partnerships, S corporations, or sole proprietorships. About 5 out of 6 businesses in the United States are run in a non-C Corp form. So the idea was that we can't give this incredible benefit to regular corporations and do absolutely nothing for the other business taxpayers in the United States. So this 20% deduction is sort of the throw-in provision in the 2017 Tax Act. And I literally mean throw-in. They did it very late in the game, and there's some problems with it. And whether they correct those with technical corrections or not, hard to say. Qualified business income, number one, has to be from a business. Can't include capital gains or dividend income. Dividend income is kind of passive income. You're not operating a trade or business. Capital gain income is tax favored. Interest income might be part of the qualified business income if it relates to the trade or business. So, for example, you generate some interest income from working capital. That's actually part of the income associated with that business. It's eligible for this 20% deduction. Any interest that you earn that's related to perhaps an investment. Let's say you've got a real estate business and you also happen to have some assets that you hold for investment purposes. And so you're generating some interest income on some cash flow that's being maintained, maybe to service the debt on the investment property. That's not part of this qualified business income, but any interest income that relates to the business itself is. Now, right away, you should probably think, How do we make those determinations? When is it related to the business? When is it not related to the business? And the answer is it's a hard thing to say, and the law really doesn't define that. Probably by regulation, eventually we're going to get some guidance on that, but regulations tend to take a couple years. They first come out in proposed form, and then eventually in temporary form, and then in final form. So it's going to be a while before we get any guidance on this. What is a business? That's a hard thing to define. It seems like a fairly simple thing, but a business requires a sufficient level of activity. So we make a distinction in the tax law between an investment and a business. Well, income from an investment is not eligible for this 20% deduction. Income from a business is. Well, what's the difference? Well, a business tends to require a sufficient level of activity. The Fifth Circuit Court of Appeals, which covers Texas, defines a business to require a sufficient quantum of focused activity. Now, you write that down, ponder it, and if you figure out what it means, give me a call and let me know, because sufficient quantum of focused activity is pretty much a fancy way of saying that you're doing a lot of stuff. If you're doing a lot of stuff, that's a business. If you're not doing a lot of stuff, that's not a business. Capital gain income is not eligible for this 20% deduction. So what do we mean by capital gain income? Well, capital gain income tends to be something that is generated from an investment activity. But the key thing is it's eligible for this favorable tax rate. We have this favorable 20% tax rate that applies to capital gain income. They're not going to let you take 20% off of that 20% rate. So we have to be dealing with the rate that applies to ordinary income. If you have a loss from a qualified business, what happens is the first thing you do is you net your gains and losses if you happen to have multiple businesses. So if I'm running 3 or 4 different businesses, I net them all together and I come up with a net profit or a net loss from the business for the year. If I end up with a net loss for the year, it carries forward to the next year. And what I mean by that is, let's say that typically I generate a $100,000 profit from my business. Well, under this new provision, $20,000, 20% of that profit, is deductible. I don't have to pay tax on that. But let's say one year I happen to generate a $50,000 loss. Well, going forward into the next year, what I'd like to do is I'd like to start all over again, fresh slate, and say if I've got $100,000 of income in the next year, I get that $20,000 deduction again. But the law says, no, if you had a $50,000 deduction, a loss in the prior year, then you're going to have to carry that forward to the next year. And when you have $100,000 of income in the next year, you have to subtract that $50,000 loss from the prior year in determining what amount of deduction you're going to get under this provision. So losses can end up reducing the current year 20% deduction. If you have your business run through an S corporation or a partnership, we call those flow-through entities. They themselves don't pay tax. They're sort of conduits. They gather the information, they pass it on to the owners. Well, as we're going to see, we're going to need to know things like what is your qualified business income. For high-income taxpayers, their deduction might be limited, and the limitation depends on whether or not it's a service business or some other type of business. So if we have a partnership or an S corporation filing a tax return, they're now going to have to classify the business as a service business or something else, and they're going to have to report that to the owners. They're also going to have to report each owner's share of W-2 wages, and these are wages not paid to that owner. They're all the wages paid out of that business, as well as the basis of business property. And the reason is if you have a high-income person and it's not a service business, the amount of the deduction can be determined based on W-2 wages paid as well as the basis of assets run in that business. And so flow-through entities, partnerships, and S corporations are going to have much more complicated returns because they're going to have to gather and report this information to the owners. Now, the income limitations mean, what does it mean to be high income? High income is a term used throughout the tax law, but it has different meanings in different situations. And the purpose of being high income in this situation is if you're high income, the amount of your deduction might be reduced. It may not be 20% of your business income. So they define high income to be $315,000 of taxable income if you're married filing a joint return, or half of that, which is $157,500, if you're another type of taxpayer. So if you're a single taxpayer, High income is 157.5. Now, the phase out, that is where you start to lose your deduction, begins at this amount, begins at $315,000. And then there's a $100,000 range that's applied to somebody who's married filing joint. So if you've got taxable income between $315,000 and $415,000, you still get the benefit of the deduction. It just starts to get ratcheted downward. Once you hit $415,000, you might end up with no deduction at all. And the answer to that depends on whether it's a service business. If it's a service business, you get no deduction at all once your taxable income hits $415,000. Or if it's another type of business, a non-service business, and we're going to define those terms, then you have a separate limitation that applies. And that limitation is based on the W-2 wages paid out of the business or the amount of capital that's utilized in that business. So let's start with a non-service business. If you have a non-service business and you're in the phase-out range, that means your taxable income is more than $315,000, married filing joint, 157.5 otherwise. Then what happens is the amount of your deduction can be reduced. Now the reduction means it's going to go to 50% of your W-2 wages, and this is all the W-2 wages paid out of their business, or 25% of the W-2 wages and 2.5% of the unadjusted basis of depreciable property used in that business. And it's the greater of those two. So we actually have to do both computations. But the key thing here is we don't have to do this at all for any taxpayer that has taxable income below that threshold amount. So if you're married filing joint, you've got $315,000 or less of taxable income, you can forget about this. This limitation doesn't apply. You get to deduct 20% of the business income. That's true whether it's a service business or another type of business. But once your taxable income gets above that threshold, your deduction might be pulled down to the greater of these two numbers. W-2 wages are those that are timely reported to the Social Security Administration. 99 times out of 100, this is done. Sometimes if somebody doesn't run their business very efficiently, maybe they're a little bit late in reporting to SSA. Now there's an additional cost to that. There's always been a penalty for failure to report to SSA, and now there's an additional penalty in the sense that you can't count those W-2 wages for purposes of this limitation. The unadjusted basis of property is depreciable property, so it doesn't include land. It also doesn't include intangibles like goodwill, customer lists. Those things can be deducted for tax purposes, but the deduction is amortization of an intangible, not depreciation. So we're talking about things like equipment, trucks, things like that. But it's the unadjusted basis, which means the basis before you've claimed any depreciation or any other tax benefits, like Section 179 allows you to expense the cost of business assets that you acquire. That's not going to affect this deduction because it's unadjusted basis. You use this for the greater of the tax law recovery period or 10 years. So if you go out and buy a piece of equipment, for tax purposes, we usually classify that as 7-year property. That means you depreciate it over 7 years. But for purposes of this limitation, you get to count that property for a full 10 years. The only exception is if you don't use it in your business anymore. So if you sell the asset or you take it out of service, then it can't be part of that unadjusted basis. And I'm going to talk a little bit later about how that might impact purchase price allocations. That's what I mean by that last bullet point, but we've got a full slide on that. So number one, the property has to be subject to the allowance for depreciation, excludes land, excludes amortizable intangibles. We include the unadjusted basis, so even if we expense the whole thing, even if we fully depreciated it, we still have to count it. So let's say we have a taxpayer that June 12th of 2018, they buy $300,000 of equipment. And this equipment happens to qualify for the ability to expense it. That's what we mean by Section 179 property. And we go ahead and we expense it. As long as we have enough income to offset that with, we might as well. But we're using the property on December 31st in a qualifying business. Then what happens is, for purposes of computing this limitation for the qualified business income deduction, we get to include the full $300,000, even though on our books we've got nothing left. because we expense the whole thing. Now, what this means is that when somebody buys a business, and by the way, this is an issue that I may leave as one of the options for a research paper later in the semester, but when somebody buys a business, they're buying a whole group of assets. So in other words, if you buy a building, you're going to use this building for investment purposes, for business purposes, you bought one asset. And so you can look at a settlement statement and you can figure out how much you paid for it, how much you have to capitalize, what amount you're allowed to depreciate. But if you go out and you buy an entire business, you've probably bought 120 assets. And then you have to take the lump sum purchase price and you have to allocate it among those 120 assets. And the tax law has a very prescribed way of doing that. And historically, if you were the buyer of property, you would try to classify the purchase cost to those things that you could write off very quickly. And that would be things like accounts receivable. You expect to collect those receivables very quickly, so you're going to get a benefit very quickly. Things like inventory. If you're going to pay for inventory, you better be able to turn it fairly quickly. And so that's something that you expect that you're going to get an immediate tax deduction for. So buyers historically have tried to allocate things to what are referred to as fast pay assets, things like receivables and inventory. We may now want to do something a little bit different. And the reason is that we're now allowed to expense or claim what's referred to as 100% bonus depreciation on certain tangible personal property. So if I buy a business, I may now want to allocate to equipment. And the reason is that I can immediately expense the equipment and get exactly the same benefit as if I had allocated to inventory or receivables. And that's a function of the new tax law. It greatly expanded your ability to do that. But the other benefit is, if I allocate to receivables and inventory, those aren't depreciable assets, so they don't count in that capital base to allow me to get a larger qualified business income deduction. But if I allocate to equipment, I get to write the whole thing off immediately, just like I would for receivables and inventory, but I get the benefit of having unadjusted basis of property, and it might increase my qualified business income deduction. So we got to think a little bit harder about how we're doing purchase price allocations going forward. Now, if you have a service business, the rule is a little bit harsher. If you have a service business, you can actually have your deduction go to zero if your taxable income hits $415,000 married filing joint, or half of that, $207,500 otherwise. So what is a service business? Well, generally we don't want one. And the reason we don't want one is we don't want this limitation to apply. It's a harder limitation. So what they do is they define it to include certain things that you and I probably would have to admit are service businesses, like the practice of accounting, law, consulting. It also includes any business where the principal asset is a skill or reputation of one or more of the employees. I'm going to read that one more time. The principal asset is a skill or reputation of one or more of the employees. You and I could reasonably disagree about what that means. So let me give you an example. I'm going to use myself as an example. I do accounting work. I'm a CPA. I do accounting work. That clearly is a service business. No question about it. It's actually specified by name. But one of the other things I do is I teach seminars. And I teach seminars on the internet. I do webinars as well as travel. And I do seminars when I travel. Now the question is that a service business? Well, most people would say, well, sure it is. That's what you're doing. You're providing a service. But it's not a specified service. In other words, it's not one of the ones that they put on the list. Teaching seminars is not included. So the real question is that a business where the principal asset is a skill or reputation of one or more of the employees, which would include me? And the answer is maybe, maybe not. And in fact, it might be. Maybe for some of the stuff that I do it is, and some other things it is not. So, for example, I teach seminars in New Mexico where people know me. I've been there a long time. They know me. I used to be the chair of the State CPA Society. People know me from that. So if they offer a seminar, there might be some people who say, I'm going to take that seminar because Hamill's teaching it. Well, that means that the principal asset, at least with respect to that program, is my reputation. But I also teach for a lot of the national CPA firms. And what they do is they offer a program. They invite people in to teach for them. They pay you to teach for them. And the folks who show up at this program, they're there because they work at that accounting firm. They don't necessarily know who they're going to see in the classroom teaching that class when they walk in. So I might be able to argue that that's not principal asset of skill or reputation of one or more of the employees. I'm kind of a generic fill-in. They just throw a teacher in there. I could make that argument. Now, if I'm an IRS agent, I'm probably going to argue something completely different. I'm probably going to say, yeah, but why did that firm hire you? Maybe the folks who are taking the program don't know who you are, but why did the firm hire you? We think it's because your skill and reputation. And some of you might think that's a reasonable interpretation. I might argue it's not. And you and I could both be reasonable in reaching that conclusion. And so in preparing my tax return, I'm going to take whatever position benefits me as long as I have substantial authority. Okay, we're required to have substantial authority for the positions that we take, which means that you've got a 40 to 45% chance of success of challenge. Well, right now, we don't really have any guidance as to what this means other than the words that you see on this PowerPoint slide. Eventually, we're going to. Eventually, we're going to have regulations. But right now, we don't really have anything. And so if I'm not a high-income taxpayer, I don't care about this. Okay, so I know I keep saying that, but remember, if you're not a high-income taxpayer, this does not affect you at all. You get the full 20% deduction. If you're a high-income taxpayer, then you're better off saying something is not a service business because it gives you a greater opportunity to get some deduction. Architects and engineers were specifically excluded from being in a service business. Now, if you ask an architect or engineer what they do, they're probably going to tell you they're in a service. Why did they do this? Well, we used to have something called the domestic production activity deduction, and this was available to architects and engineers, not to other people in service businesses. So one possibility is that they kept this in the law because they had taken a benefit away from architects and engineers, so they wanted to leave something in place for them. Other than that, there's probably no logic for it. We also have some old IRS rulings. IRS rulings are not authoritative. They're just the position of the IRS, but they give us some guidance that say veterinarians are in a service business. You'd say, well, gee, that's kind of obvious, but it really isn't because the law says that people in the medical profession are in a service business. And you say, okay, what is that? Is treating dogs and cats? Is that in the medical field? And the IRS said, well, yeah, it is. It is. Physical therapists, they're in a service business. But we're going to have a lot of disputes going forward with this skill and reputation issue. And there's no definitive answer as to exactly how you deal with that. So now let's go through a couple of examples of this. Let's say we have a taxpayer filing joint. Qualified business income is $200,000. Taxable income is $300,000. So they're below the threshold. We don't have to worry about some special limitation. But there's a general limitation. Now, general limitation says that you take 20% of your business income, but you can't deduct more than 20% of your taxable income. And in computing taxable income, you have to carve out your net capital gain income. And the reason is that's tax favored. It gets a special rate. So the QBI deduction, its base amount is 20% of $200,000. That's $40,000. That's going to be limited to our taxable income, $300,000, reduced by the net capital gain that's included in taxable income. So 20% of $250,000 is $50,000. So we get a $40,000 deduction because that limitation doesn't apply. Now let's say it's the same deal except taxable income is $220,000, and that includes $50,000 of net capital gain income. Now we again have a $40,000 base deduction, but that's limited to 20% of taxable income reduced by the capital gain. 20% of taxable income reduced by the capital gain is $34,000. So our deduction is going to be limited to $34,000 in example 2. Now, if we're above the threshold, meaning we're above $315,000 of taxable income, a whole different set of rules comes into play. Because now our deduction might be reduced from that 20% figure down to something else. If it's a service business, it might be reduced down to 0. If it's not a service business, it gets reduced to the greater of the 50% of W-2 wages or 25% of W-2 and 2.5% of our capital. So let's say we've got a taxpayer. This is a base example. Qualified business income, $200,000. Married filing joint, $250,000 of taxable income. We're not in the threshold range, so we get a $40,000 deduction. Okay, so no problem there because we're not high income. Now let's change this and say not only are we high income, but we're past the phase-out range. Starts at $315,000, it ends at $415,000. This guy has taxable income of $450,000. His qualified business income is $100,000. So the first thing we do is we say, what's a normal deduction? What's 20% of the income? $20,000. The problem is we say that $20,000 might be reduced to a lower number. We got to figure out, will it be reduced to a lower number because we're past the phase-out range. So what we do is we then take 50% of our W-2 wages. Okay, that's one possibility for the lowered deduction. 50% of $60,000 is $30,000. The other thing that we do is we take 25% of the W-2 wages plus 2.5% of the unadjusted basis of capital, depreciable property. So let's say that the depreciable property is $400,000. So 25% of W-2 wages is $15,000, and 2.5% of $400,000 is $10,000. Well, 15 plus 10 is $25,000. So we say, okay, we're in the phase-out range. Our deduction might be reduced to the greater of the wage limit or the wage capital limit. Well, the greater of those two numbers is $30,000. So we say to ourselves, is our $20,000 deduction, which is 20% of qualified business income, is that going to get reduced? And the answer in this case is no, it's not. And the reason is that the wage limitation exceeds 20% of taxable income of our qualified business income. So we're actually going to get a lower deduction just taking 20% of qualified business income. So anybody in this phase-out range, if we're talking about something other than a service business, it may be they get the full 20% of their qualified business income. The only exception to that is if the wage capital limitation can pull them down to a lower number. So anytime 20% of qualified business income exceeds that wage capital limit, we just go ahead and take 20% of qualified business income without regard to our taxable income. Okay, now let's say it's the same situation, except qualified business income is $200,000. Remember, the last example was $100,000. So what's going to happen is a normal QBI deduction is $40,000. That's 20% of 200. And there is a typo here that carries through some other slides. It says normal QBI deduction is $40,000. That parenthetical should say 20% of 200,000, not 100. I copied this slide and unfortunately didn't make a change in that parenthetical. The W-2 wages and the unadjusted basis exactly the same as example 4. So what happens is that our normal deduction is $40,000, but that gets pulled down to $30,000. It gets pulled down to $30,000 because our taxable income is above $415,000. Now in example 4, it didn't get reduced. But that was because in example 4, the normal QBI deduction was only 20. So we don't reduce it to 30. It doesn't make any sense to reduce it to a higher number. But in this case, we reduce the 40 all the way down to 30. Now example 6, same thing as example 5, except instead of being all the way through the phase-out range, instead of having taxable income of $450,000, this guy has taxable income of $385,000. Well, the phase-out range begins at $315,000, it ends at $415,000. So this guy is 70% of the way through that phase-out range. So what happens is we begin with the normal deduction of $40,000. And now we're going to pull that down. But we don't pull it down all the way to $30,000 because he's not all the way through the phase-out. We pull it down by 70%. So QBI deduction is $40,000. The wage limitation is 30. 40 minus 30 is 10. So we have a possible reduction of $10,000, but we only reduce it by 70% of the $10,000. So we go from 40 down to 33. And notice in example 5, because the taxable income was all the way through the phase-out range, we're at $450,000, we had a 100% reduction. So it went from 40 to 30. Here we go 40 to 33. Okay, now let's say the taxable income is $4 million. We're way through the phase-out range. Qualified business income is $2 million. So the normal deduction is $400,000, 20% of the $2 million. Now let's say that we have no W-2 wages. This is a real estate business. We're not paying anybody for anything. We use contractors. We don't have any employees. But we've got $40 million of assets that we're using in this business. Well, the wage limit is 0. 50% of 0 is 0. But the wage capital limitation is 25% of the W-2 wages, which is 0, plus 2.5% of the $40 million. Well, 2.5% of $40 million is $1 million. So the wage capital limitation becomes $1 million. Now, because our deduction of $400,000 is less than the $1 million, we don't reduce the 400 to $1 million. Obviously, we can't do that, right? So the 20% deduction is actually less than the limitation that applies to high-income taxpayers. So we go ahead and we deduct the $400,000. Example 8, same situation, except I simply reduce the taxable income and reduce the unadjusted basis. So we got QBI of $2 million. We've got a deduction of $400,000. No W-2 wages, unadjusted basis of capital is $8 million. 2.5% of $8 million is $200,000. So we're high income. We're all the way through the phase-out range. We have a normal deduction of $400,000, but that gets reduced all the way down to $200,000. $200,000 being the greater of 50% of the wages, or 25% of the wages, and 2.5% of the capital. So basically notice that in example 7, we had so much unadjusted basis of property that it turns out that we got the full 20% QBI deduction because that was actually more than the limitation. It was a more punitive provision, I should say, than reducing it to our $1 million, 2.5% of unadjusted basis. Whereas in example 8, 2.5% of the unadjusted basis was more punitive. It pulled us down from a $400,000 deduction to a $200,000. Now, this is simply to point out that you don't necessarily have to be employing anybody. You could use independent contractors, but you better have some capital. So if you've got a business that has a lot of capital, even if you're a high-income taxpayer, you can end up with a substantial deduction. So this is a good example of a real estate operation. The only issue with a real estate operation, though, is it has to be a trade or business. Can't be an investment. And trade or business, I pointed out earlier, is not a well-defined term. Here are some citations to the tax law. Not really important that you know the code sections, but you'll notice there's a bunch of different code sections. And what I mean by that is that the terminology trade or business is defined multiple times in the tax law, and it's not always the same definition. We don't know for purposes of this provision exactly what definition will apply. I suspect it's going to be the test in Section 162, which is ordinary and necessary trade or business expenses. That's actually a lower threshold than some of the other tests that use that terminology trade or business. But real estate sometimes is hard to qualify as a trade or business because it's not. It's an investment. So we need to make sure that it's a trade or business if we're going to take advantage of that deduction. Now, if we have a service business is more harsh than a non-service business because if our taxable income goes all the way through the phase-out range, we get no deduction at all. So I begin at $315,000 taxable income, married filing joint. If I'm below that, say my taxable income is $250,000, I get a 20% deduction for my service income, no limitations whatsoever. If my taxable income is, say, $500,000, so it's all the way through the phase-out range. If it's a service business, I get no deduction at all. So let's say we have a taxpayer with taxable income of $450,000. They're all the way through the phase-out range. They've got $200,000 of business income from a law practice. Well, law practice is clearly a service firm. So the normal deduction is $40,000, but what's going to happen is that's going to be reduced all the way down to 0. Now, the first thing I do is I do go ahead and do the wage capital computation, because even that service business deduction does get pulled down to the wage capital limit. The only difference is that instead of getting pulled down just to the wage capital limit, like in our real estate business, we decided we went from 400 to 200. In the case of a service business, once you hit 415,000 of taxable income, your deduction gets pulled all the way down to zero. So let's say that we've got a taxpayer with taxable income of 385,000. And again, we did this example before. They're 70% of the way through the phase-out range. 200,000 of income from a law practice. The normal deduction is 40,000. Okay, we then say to ourselves, yes, but this is a high-income person. This person's above 315,000. So we now need to determine, does that normal deduction get reduced? So we're going to do the wage and the wage capital limit. The wage limit is 50% of the W-2 wages. That's $30,000. The wage capital limitation is 25% of the wages, 15,000, plus 2.5% of the unadjusted basis. That's 10. 15 plus 10 is 25. 30,000 is more than 25. So we say, okay, the wage limitation is 30,000. So as we start to go through this phase-out range, two things happen. Number one, if it's a service business, our deduction gets ratcheted all the way down to 30,000. A non-service business, that wasn't true. We went from 40 all the way down to 30 as we moved through the phase-out range. In the case of a service business, we say the limitation is 30. That's what we're starting with. We then ask ourselves, how far through the phase-out range are we? Well, the phase-out range is 315 to 415. We're 70% of the way through. So we say, okay, we lose 70% of the otherwise allowed deduction. The otherwise allowed deduction is 30,000, and that gets reduced to 9. And by the way, you read the statute. It's not clear that this is how it's computed. But the Joint Committee on Taxation has some examples that they did as part of the legislation. And the Joint Committee on Taxation examples are done like this. So they tell us that with a service business, that wage capital limitation is still relevant, and it's actually the starting point for what we do to determine the amount of the deduction. Okay, some ancillary issues that we have to think about. Number one is this threshold income, the phase-out, is based on taxable income. Very often the tax law used adjusted gross income, which is a taxpayer's gross income minus certain deductions. This is taxable income, which means beginning in 2018, married filing joint gets a standard deduction of $24,000. Whether you have any itemized deductions or not, you get at least $24,000. So that means you could actually earn $339,000 and have taxable income of only $315,000. So let's say I have a service business. I come to you for help. I say, well, I'm an attorney. You say, well, how much money did you make last year? And I say, well, $339,000. I'm married filing joint, $339,000. Then you're going to tell me, even though you made $339,000, you're not a high-income taxpayer because you get a $24,000 standard deduction. That pulls your taxable income down to $315,000, and you get to deduct 20% of the income from your law practice. No limitations whatsoever. And this also means that any deductions that I can generate on my tax return, if I'm in that phase-out range, that 315 to 415, I might be able to create a 120% tax benefit for every dollar of deductions. So let's say that I've got $385,000 of taxable income, 70% of the way through that phase-out range. And I say, well, I have an opportunity to make a $10,000 retirement plan contribution. I ask you, how much is that going to save me? Ordinarily, you would say $10,000 deduction times your marginal tax rate. But now you're going to say, you know, if you make a $10,000 deduction, that's going to reduce your taxable income. And if you reduce your taxable income, then that means that you're going to get a larger qualified business income deduction. So you could actually get a benefit of a $10,000 deduction, plus also potentially free up an additional $2,000 of deductions for the qualified business income. You could get a $12,000 deduction for a $10,000 contribution. So anything that I can deduct, not just retirement plan contributions, maybe charitable contributions, those sorts of things can actually give me a greater benefit than I ordinarily would get. Also, the law is not clear, and that means that there's going to be some gamesmanship. Well, the government already understands that, so they said, okay, go ahead and play games, but we've got a couple of things that we can use to pull the rug out from under you. Number one is we're going to give the Treasury Department that enforces the tax law the authority to write regulations. What that means is that any regulations they write have the force of law. And so we're going to figure out what kind of games people are playing. People come up with very aggressive strategies that we don't think work. We're going to say by regulation that that doesn't work. We're going to shut that down. And the second thing is that we have a penalty that applies if somebody takes an aggressive tax position. And ordinarily that requires that that aggressive tax position cause a 10% understatement in their tax liability. So in other words, if my tax liability for the year is $50,000, in order for that penalty to apply, the position that I'm taking, that aggressive position, has to save me more than $5,000 in tax, 10% of the $50,000 that I otherwise would owe. But if I'm taking an aggressive position on this qualified business income deduction, they lowered the threshold just for that one item to 5%. So if my tax liability is $50,000, the rule is that I could actually get hit with a 20% penalty if I use that qualified business income deduction in a way that doesn't have substantial authority and reduces my tax liability by $2,500 or more. So those are a couple things that they're thinking about to try to maybe mitigate how aggressive people are with these filing positions. The second page of a tax return is going to look pretty strange now. And the reason is that this limitation for the deduction is 20% of taxable income, but it's taxable income before the deduction. Otherwise, we get into the circular computation. So we're going to now see the second page of the tax return lead us to taxable income before this deduction. And then that number is going to be used to determine that 20% of taxable income limitation. And then we're going to plug in the deduction. And then we're going to have the second variation of taxable income. Some states with an income tax, Texas obviously does not have an income tax, but states with an income tax very often begin with federal adjusted gross income. And because this deduction is after taxable income, it doesn't come into play for federal adjusted gross income. So any state that piggybacks off of the federal system, you're actually not going to get this deduction for state tax purposes unless they change the law. Now let's say you got an S-corp or a partnership. I mentioned earlier, we're going to have more complicated partnership and S-corporation tax returns because we're going to have to show the partners and the shareholders what their share of W-2 wages is, what their share of qualified business income is, what their share of unadjusted basis is. The question is, how do we determine their share? And the answer is based on how they're allocating the deduction for the wages. So your share of W-2 wages is based on your share of the deduction for W-2 wages paid by the partnership or S-corp. Your share of capital is based on how you share depreciation. But remember that capital hangs there for 10 years. So let's say that I'm in a partnership. Partnership goes out and buys $100,000 of equipment and writes it off immediately. They're allowed to do that. And they allocate to me my share of that deduction. I then say, okay, my share of the basis of the property for purposes of this limitation is, let's say, 25%. That's the amount of the deduction they gave to me. Now let's say 5 years later, I sell my interest to you. The statute says that we allocate this unadjusted basis in the same manner as the deduction for depreciation on that property. Well, you never got any depreciation on that property. I took it all. I took it all 5 years ago. Do you get to continue to use my share of the unadjusted basis if you're a high-income taxpayer? Logically, I would say the answer is yes. But the regulations are probably going to have to say that. Right now, we don't have an answer to that. Partnerships are also, in some cases, allowed to adjust the basis of their assets. When somebody buys into the partnership, they're allowed to do that. Or if somebody receives a distribution from the partnership, there are certain adjustments that partnerships are allowed to make. What's not clear is if we're adjusting the basis of the property for one of these items, does that then become part of the unadjusted basis? Logically, it should, but again, I think they're going to have to tell us by regulation. And then finally, depreciation schedules. Being good little accountants, we know we have to keep depreciation schedules. Well, the problem is that our depreciation schedules for assets that we immediately expense or that we deduct 100% depreciation, they're going to show no basis. But we're going to have to continue to follow those assets because those assets are going to continue to be in this unadjusted basis of property for 10 years. And so it's going to become very important that we have depreciation schedules that we maintain even when our fixed assets are gone. And I mean gone in the sense that we fully expense them. If they literally are gone, we're not using them in the business anymore, we're not allowed to count them. But otherwise, we're going to have a little bit more difficult time tracking all of these things.